Well, with looming uncertainty about the effect of U.S. President Donald Trump's tariffs on U.S. inflation and economic growth in the United States, the U.S. Fed is expected to leave its key interest rate unchanged later today for a fourth consecutive meeting. Let's talk about it with an expert. We'll go to Luis Alvarado, Global Fixed Income Strategist at Wells Fargo Investment Institute. He joins us from San Francisco. Luis, thanks very much for joining us. What do you expect from the Fed today? I assume you expect no change to the benchmark interest rate. Do you expect to see anything different, for instance, in the dot plots, which is a forecast of open market committee members on where rates are going? Do you expect any change in the tone of commentary from Chair Jerome Powell?
Thank you, Paul. Yes, unfortunately, we don't expect much change because there's pretty much not much for the Fed to go on. They're still waiting for the hard data to reflect some sort of slowdown or problems that are arising for them to be able to act. Like you well mentioned, the dot plot is going to be the first impression that we get. But what does the voting members and the FOMC sees moving forward? Most likely we will see an update in that dot plot, probably reflecting one rate cut as the median point for the remainder of 2025. And perhaps we get a little bit of a better idea of what the Fed officials are thinking for 2026.
I've had a couple of conversations this week about the U.S. economy with experts, and they caution investors not to assume that U.S. tariff policy is going to be economically benign. It did seem to be fairly benign in the May inflation reading in the United States, but I've had guests caution me that we may see in months ahead in 2025 a pronounced impact on things like inflation or economic growth arising from the tariffs. Do you agree?
Yes, unfortunately, we do agree with that statement. There's still a lot of uncertainty on how the tariffs and the trade and negotiations are going to develop. So the next 60 days will be key as those expirations start hitting with the rest of the trading partners around July 9 and then with China in August. There's still a lot of things up in the air. Obviously, there's been other focus of attention right now for the market, but I think, or we believe, that is going to start gravitating very quickly, very soon to what's going to happen with sort of reciprocal tariffs. And regardless of what happens, if the average tariff rate still ends up being higher than what it was prior to this sort of inception of tariffs, that still is detrimental to the U.S. economy because it is effectively acting as a tax for U.S. consumers. And that's what the Fed is looking at. They're not looking so much at the lagging previous data on inflation or unemployment. They're keeping their position on hold because they think that inflation and a slowdown of economic growth will most likely appear towards the end of the year.
So what's your call, one or two rate cuts from the Fed in 2025?
In 2025, we only have one rate cut embedded in there. Again, it's a very narrow corridor where you can kind of see an economic slowdown and it's a big if, inflation allows. There's no real rush for the Fed to cut. Obviously, there's pressure from the administration to act, but I believe, and we believe that, the committee and Chair Powell want to remain independent, really want to assess and look at what's happening with the data, and they have the tools to react and to act appropriately eventually, but they don't want to do it preemptively because there's still a lot of things at stake.
Do you expect the Fed or Jerome Powell to make a detailed comment about the conflict in the Middle East, or only a passing reference to it? I've just spoken to a portfolio manager who says, not surprisingly, that the thing for investors to watch from the conflict in Iran and Israel is the price of oil.
Yeah, definitely. The price of oil has been the economic indicator that is flashing. There's still potential problems, especially if Iran starts moving towards the Strait of Hormuz. And then, things could get further complicated, of course, if there's bigger U.S. involvement. At this point in time, we consider that, tail risk events. And although those tails are getting fatter, we don't see much reflection in U.S. Treasury yields, meaning that investors are moving into sort of perceived safe haven assets like U.S. Treasuries or even the U.S. dollar as well, not even gold. So for now, we believe investors are remaining fairly assessing the situation that is fairly contained. If, however, there's an escalation of how things are right now, we would expect traditional perceived safe haven assets to rally, but that's not really happening right now. So we believe the Fed is going to perhaps mention it, most likely not on the actual statement, but in the press conference from Powell, just acknowledging that they're obviously, as everybody else, acknowledging the situation, but not really being a key determinant for Fed policy.
Okay, you are a fixed income strategist. How do fixed income investors, or how do investors within the fixed income portions of their portfolios manage all of this?
Absolutely. So the first thing is we want investors to gravitate towards quality. There's a lot of opportunity for investors to receive a total return that is positive. And the biggest, I would say, component of that is the income return that investors can get from fixed income. We're not really expecting interest rates to move much higher or lower from where they are right now. We're not really expecting credit spreads to move much higher or lower. So we believe that investors are okay positioned by diversifying, across multiple different assets to be able to receive a positive total return over the next 12 months. And the biggest component of that will be through income. We like places like corporate grade, investment grade corporate bonds. We like mortgage-backed securities. And then for investors here in the U.S. that are in a high tax bracket, in a state that has a high tax rate, we also believe that municipal bonds are attractive.